In this update, I'll show you which new ETF I've bought, and also why with detailed analysis. But first, something else. Did you also see that Trump has come to power and is doing all sorts of crazy things? Elon Musk, who is also quite enthusiastic, is getting a lot of praise as an entrepreneur. But what he's doing might not be suitable for everyone right now. Now, the entire American market is starting, right? It's really about the heat. There are also a lot of benefits, like the announced investment of $500 billion in artificial intelligence, data centers, that sort of thing. By the way, I recently also took a small position in a small stock that focuses on electric solutions needed for data centers. Before that, I also have an update on my investment portfolio, but here we're going to specifically talk about ETFs. However, I am a bit worried. Not so much about the whole world. I'm not really that interested in it. That's always a long-term thing. Well, okay, but Aki's Trump supporters reflected back in the crypto market, forget risks in the crypto market. People forget what the risks mean. And I want to assure you, this is probably the last phase of the bubble. It's probably going to go up a bit more, but I'm really afraid that a big correction might be coming, but no one knows for sure. So you shouldn't do too much market timing. That's also what I do. But I've already announced in other portfolio updates that I'm increasingly shifting my positions to Europe. And this recently launched ETF is another example of that, where I've built up a larger position, not in Europe, but in China. That's already the first warning. My risk profile is much higher than most people's. I only invest in higher risk growth stocks. I really have a passion for growth stocks and companies. And that also comes from my background. University, I did my higher professional education in business administration. I've been an entrepreneur for over 10 years myself. Also, more than 10 years as an investor. Actually, my reasoning comes a bit like a milestone. Started with all these kinds of things, and I've built my wealth from zero to now more than 425,000 euro in liquid assets. So that's on the side. All the other side matters, like my business, my home, and a few other things. Now, this liquid wealth is enough for me at my age that I feel financially secure. However, I've always said, yes, I think I will become a millionaire by the time I'm 40. Why? Just because it can, and you've just shared a lot necessary. And in the long run, if you've played the long-term investment game, what you need to do then is keep your assets constantly in the game. Hold, but definitely at that high risk assets, not crypto. That's an even higher risk. That's speculation. Fortunately, I don't do that anymore. Yeah, then you also miss out on opportunities, definitely, and that's not what it's about. I just feel that way about the stock market. You can work much more strategically there. Go ahead. So that's no longer speculation, but that's investing, and that's always a gamble. You always keep putting money on opportunities. So investing is a calculation of chances. Now, I have no idea what the crypto market is going to do. That will probably explode in the coming months because of all the Trump stuff. But everything that explodes will also implode sooner or later. It's just happening too fast. But that's not just true for crypto. That's also true for stocks and such. So yeah, then at least you have ETFs as a lower risk product. And I think that every ETF investor is definitely a smart investor. It's super hard to beat the market, whether you like it or not, and I'm trying it too, but because I just enjoy it. However, if you don't do this as a full-time job, I personally think, is it going to be really difficult? Not only because you have to do a lot of research, but also because you need to have a ton of emotional discipline, and that's definitely harder on a daily basis. While you need to play for the long term, that's why I stay in higher risk categories, I would say. And the crucial condition for this is that it continues for the very long term. I'm now 33, and I still have, let's say, 30 or 40 years to invest. So hiccups, temporary setbacks, I can recover from those. However, my portfolio has grown so much that I no longer want to take the risk of being thrown out of the game. It's a game. Keep playing. Let's take a look at the update for the ETF and also the reason why I invested in this ETF. The American stock market is really on steroids right now. US stocks make up more than 70% of a global index. It is really very high. If we look at historical developments, we can see that American stocks are, relatively speaking, right now super expensive. This is actually relatively speaking compared to the West or the world. And we also see that the valuation, for example, during the internet bubble was significantly lower. And also the Nifty 50 bubble, which was a long time ago, significantly lower than the current price. And now Trump has taken office. It could very well be that 2025 is the last year with huge hype. Maybe it's the last phase because the stocks are still climbing. But no one knows for sure. And one thing is clear, the stocks are very high. Now, the thesis is to invest in Chinese stocks. and I have one there. I invested in a proportion, and I'll show you in this ETF update why. First of all, for example, take a look at the valuation of Alibaba. The price has risen significantly, fallen in recent years. However, we see that the EPS line has only gone up. In other words, it makes more profit. The same goes for GD.com. Prices have dropped significantly and profits have risen sharply. The same goes for Tencent, although to a lesser extent. And in comparison, for example, with Meta or Amazon, we see here the price of Amazon has also risen significantly. And this is, however, in line with the profit. So if we compare that with, for example, a GD.com or a Baby, you can see the gap is quite large. That means the price is well below the EPS line. And in simple terms, that's just good news, because that means you're getting more value for the price you pay. Price is what you pay and value is what you get. That's what Warren Buffett says. Warren Buffett himself has also sold a lot of his shares. He has increasingly taken a larger cash position with his Berkshire Hathaway company. And yes, I have also made a big transition to European stocks in my portfolio. I've been doing this since actually mid-2024. Also, the valuations just don't sit well with me. And in Europe, you can still buy good, strong companies. Now, the full update I give regularly. Every month I give a new update on the stock positions. But now we're looking at the ETF portfolio. For the stock positions, follow our channel for updates, why I bought some stocks. And recently I've also been doing a lot transactions to buy more. So it's definitely worth checking out that video too. The last video is from the beginning of this year. So definitely take a look at that one too, with a full explanation of the stock strategy. And of course, if you're trying to time things a bit at the start, it can be a bit disappointing. There are a number of stocks that are not performing well, but this is just a temporary situation. I am 100% convinced of that. An example is just Teleperformance has a very low valuation and interesting good opportunities. We're really talking about the ETFs here, and you can see that in my ETF portfolio, there's only one ETF, and that is the KraneShares China Internet ETF. And this includes various Chinese companies focused on technology. I am one myself. Good investors, high ICE risk profile, and I'm mainly into technology or quickly scalable business models like private equity, for example. I also talked more about that in my latest portfolio update. For example, Technion, in such a case, this stock could easily go up 10 times, but maybe even 50 times. The only thing you need is a lot of patience and a bit of luck, because you never know how the company will be doing in 20 years. The China Internet ETF has risen significantly, while the profits have increased. As I just showed you, that simply the value has become interesting. And of course, there are risks. But if the Chinese government starts implementing stimulus measures, then it could turn around very quickly. The current position at this moment is 20,000 rounded up, and that's about 10% of the total portfolio. I actually wanted to buy the China Internet ETF in my second portfolio, the China buying the Internet ETF. However, for about 10% at Interactive Brokers, I currently can't buy the ticker I want, so that's a bit of a shame. But yes, I also have DEGIRO, and for me it works to buy the ETF I want through DEGIRO, to buy the ETF that I want. Recent transactions, you can especially see that I've bought a lot more lately, so definitely follow our channel and the monthly portfolio update, because I'm going to explain to you why I bought these shares. However, you see here for the KraneShares ETF, and the first time I bought the ETF was quite a while ago, namely April 2022. As you can see, April 2022, there was a huge spike. Here, Chinese internet stocks were very overvalued. Actually, it dropped between 2020 and April. That's about here. So I had bought at minus 75%. It even dropped further to minus 80%. But anyway, this is from an all-time high where it was overvalued. However, waking up to a somewhat more reasonable scenario, which was still on the higher side, then the ETF has still dropped by 6% scenario, which was still on the higher side. Then the ETF has still dropped by 6%. So you can also see the enormous volatility that such a thematic ETF, in this case for Chinese internet stocks, can bring about. Well, the first position was in April 2022, and actually, the price is about the same today. So basically, the purchase was just way too early, because 2022, we are now, let's say, almost 3 years later for convenience. So for 3 years, it was just what they call dead money. It was invested, but it hasn't yielded any returns. So it has actually just been a really bad investment. It hasn't resulted in any losses, but it hasn't yielded any returns. And as an investor, you're obviously looking for returns. So that's definitely a big lesson learned for me. If you buy too early after a significant drop, it can also fall quite hard. But you never really know when exactly the drop is or the bottom. That's always very difficult. Drop is or bottom, that's always very difficult to time it. And with stocks, I find it a bit easier to determine because then you can really look more at the valuation and better assess whether there is a margin of safety and that you buy below the intrinsic value. Now, my second purchase of the KWEB ETF was in 2023, so that's actually almost a year later. And then recently bought more in the summer of 2024, a slightly larger position, but not a whole lot. And recently I've been buying more, and now my position is about 10% of the total portfolio that we see here. And I actually think that's enough. If it drops further in the short term, that could still be an interesting entry point to buy more. You never know what might happen. It could still drop by about 20%. So that's quite significant. And I'm not surprised that happens. Yeah, and if that happens, it seems like an interesting buy to me. Well, what do we need to know about the KraneShares small internet ETF? But first of all, let's start with the negative. That's easier said than done. The costs are relatively high, 0.7% per year. So you could also say maybe I'll just buy a bundle of 5 or 10 Chinese stocks, and I'm just holding on to that for a long time. But yeah, holding on to that for a long time might be a bit difficult, and then it seems like your portfolio is completely saturated if you do that with multiple strategies. That you have at least 50 stocks, then you might as well just buy an ETF. The only thing is that the costs are quite high regarding holdings. We're actually mainly focused on the major powers. So we see larger positions of 10% in Tencent, Alibaba, and then the percentage of holdings decreases for each different company and stock. Some of these stocks really do seem very attractively valued. The overall valuation is not provided on Tencent's website. The KraneShares, that's definitely a downside. They often provide, for example, iShares or Invesco indicates this is the average price to earnings, price to book value, the return on equity that is generally achieved, but we don't find that with KraneShares and also not in the fact sheet. So that's a small downside. But it doesn't have, we can just look at individual stocks to see if the valuation is okay. Moreover, there are similar comparable ETFs from other providers. Definitely research that too. And there you usually find an overall valuation that comes out around a price to earnings of 15. And a price to earnings of 15 isn't bad at the moment, especially considering the S&P 500, which is quite high. So you'll have to invest differently. Do you want to achieve a higher return? The only question is, yes, is it not too early? Entry moment. Even now in 2025, there are always risks. China does have some disadvantages from a macroeconomic perspective. Also with real estate, a bit of inflation perhaps, but that can actually contribute to the stocks. Just the whole thesis, and I will repeat that. For this ETF, that's if the Chinese government implements stimulus measures, that's an extra gain. It doesn't have to come from there. The stocks in the KraneShares ETF are of high quality, especially with a lot of free cash flow. And in the long run, they win. High quality companies with a lot of cash flow, almost always. That's just a law in economics. The strongest companies that can spend more capital can either crush their competitors or buy them out. And the winner takes all. You can also see that in the Invesco QQQ ETF or the Nasdaq 100. You can see it clearly. The biggest companies keep winning, and profitability is the key factor of quality. The KraneShares Shares ETF, actually, for a very long time, it received a sell rating from the quantitative model. It doesn't really say much. I mainly use this for stocks, and for ETFs, it's just nice to show something. At the moment, we're getting it from compared to various other ETFs, a total of 2,800. As we can see here on the screen, it gets a hold rating, but that's mainly because the momentum isn't really positive. Yeah, you don't need to be a genius to see that a horizontal price trend isn't exactly a positive momentum and that the others are declining. To see that a horizontal price trend isn't exactly a positive momentum and that the others are declining. So it's not super interesting to show. What's more interesting is to look at the individual companies and what kind of valuation they have. But first, let's talk about this ETF. Cost, 0.7%. We're seeing liquidity. That's really very good because there are 5 billion in assets under management. In this fund, ouch, So that's really good. And the daily volume is quite substantial. So if you want to sell quickly as a small investor, then you probably won't have any liquidity issues for this fund. The risk is, of course, very high. The risk is, of course, very high. The standard deviation is super high. So that already means that this is not for the low risk avoiding investor. This is really more for investors with a strong stomach who are also focused on a bit of growth and who are willing to invest differently than the whole market. And again, I don't know if this is a good entry point early 2025. Why? Just because of the whole story with Trump in America. It could very well be that it takes a year or maybe even 2 or 3 years that the stock market just keeps rising. Only the valuation has risen so much that in America, the downside risk is simply starting to become much greater than the upside potential. So, myself, I've decided to allocate much more of my money to low risk stocks outside and of Europe. But we'll see over time if that's a good choice. So the risk is very high. The turnover is also a bit higher than I would like. And you can also see that 60% of the total money in this ETF, the investment is in the top 10. So it's really important to know what the top 10 is. By the way, there are about 30 holdings in the Crane ETF, and the entire holdings list, you can find that on the website itself. Here you only find the top 10, but you can download a file here, and then you'll find all the holdings. Let's take a look at Alibaba as an example. Alibaba, I'm not saying it's a great company, and there are, I think, better examples in China, ETF, but more on that in a moment. But the valuation of Alibaba seems just reasonable at the moment. Reasonably okay with price to earnings ratio of 17. For next year, it's even estimated to be 12. And the PEC ratio comes down to 0.6. The bad luck ratio is in relation to the EPS growth for the next 5 years. And anything below 1 is usually undervalued. Only for stronger, higher quality companies do you not often find a PEC ratio below 1. So that's quite interesting. The price to cash flow is also relatively low. This is the operational cash flow. We see the market value is still relatively high, but the total cash is just 55 billion. So out of the market cap of 200 billion, 55 billion is in cash. So that's quite a lot. So that's 1/4. And they have a debt of 33 billion, but that's also partly long-term debt. So we don't need to worry about that. You can always check what the free cash flow is. That's always super important. You can also see that the cash flow has decreased a bit compared to 2021 and 2020. However, that's quite something. Strong companies can definitely bounce back. There's also something very interesting about China. This is, of course, about the war of artificial intelligence. Well, the United States is definitely leading the way. That's clear. However, China does have a big advantage, and that is cheap electricity. So companies can significantly reduce their costs with all their data centers in China. I believe the personnel costs are also lower, as far as I know. So yeah, the cost advantage is maybe a thing here, and I don't think everyone thinks about that. You see the cash flow from operations, and then you also see the capital expenditure. Well, so the free cash flow is calculated quickly, 15 billion. That's quite a substantial amount of money. Another stock that's in there, for example, is Trip.com. And that seems fine in itself. Not very interesting in terms of valuation. The PE ratio is relatively low. And the non-GAAP PE ratio is low as well. Cash flow is just okay. Book value seems to be fine. So Tripcom, it's also an example of having a lot of cash in relation to the market cap. Relatively okay. Debt, no. And if we look at the profitability of Tripcom, it's also very high. A profit margin of 31% at the moment. The return on equity is surprisingly, well, a bit lower, but the profit margin is really very high. Alibaba. We can also see that the quality is there. You recognize it by the term profitability, the profitability. If the profitability is high, certainly. Comparable companies then. That often means it's a niche or industry leader that can achieve higher profit margins because they simply have a better value proposition. A value proposition. Alibaba's net income is actually a bit lower at the moment. The average for 55-year-olds was a bit higher. So Alibaba not only has the potential to rise in price, purely based on a cheaper valuation with profit growth, but also if they improve the profit margin again, back to the historical level, yes, then the stock price will go up even more. EDD Holdings, of course, known for other types, a company that includes PDD Holdings, and we see the low valuation here. A luck ratio below 1, profitability is also very strong at the moment. Maybe it's situational that it's so high. With a return on equity of 50%, that's obviously not sustainable, but we see countless examples. As Baidu, higher profits, PE ratio below 10 even, and Baidu, price to cash flow below 7. The market value has dropped to just 30 billion, of which actually 40% or something like that in cash position. That, I say even more. So that's actually even better. So that's more than half and is in cash position. So that's huge. So Baidu already has a low price for earnings, and then even more of it is in cash. Okay, they still have total debts. Let's subtract those two from each other. Then you have 7 billion in positive cash balance. Yes, interesting. Still 20% of the market value. Then other companies like Tencent also look okay. The profitability of Tencent is also strong again, so I can just keep going like this. Meituan, also relatively cheap. Does it have a growth potential that can be enormous? If we look at the current price earnings of Meituan, however you pronounce it, price earnings is 20, and the EPS growth is expected to be above 20. Percentages are, that sounds really high. Just take a look at the website. For example, take a look at the balance sheet of this company. The revenue growth is really huge. Since 2016 or 2015, it was a super small company. And in the meantime, it's really growing into a large billion-dollar company. Crazy, really interesting to investigate these kinds of companies and see how quickly they can grow. That's really quite impressive, isn't it? And you see very high potential profits that they can achieve. So everything seems to indicate that as if these stocks can outperform, especially compared to the S&P 500.